Okay, welcome everyone. We are recording our live Q&A today. We have gotten some questions from people that we're definitely going to answer, along with just giving an update of the past week because everything is just changing so quickly and just new information becomes available. So we want to be sure that we're explaining things to you as they come. This is being recorded. It was meant to be live, but we know that technology sometimes just isn't on our side. So we're recording this and then replaying. So please feel free to enter any questions in the comments. We will get answers to you if it's something we can quickly, then we can, but also we'll just answer those questions next week. So this has been great because we've gotten questions throughout the last week, and that's what we're gonna go through today, and then we'll continue to go through new questions that we get from you. So we're just going to start by having Rob give us an update, just a market and economic update of what's happened this last week, and he's got some slides prepared for us too. So Rob, why don't you go ahead and just kind of update us on what's happened in the market or the economy over the last week?
Sure. Yeah, absolutely. Hello, everyone. So I put out a blog post this week just talking about this dynamic we have where the stock market and the real economy seem to be moving in different directions. So if you look at what the stock market has done, if you kind of flip to the next slide there, Michelle, what you see is the stock market has actually done pretty well when you look at what is going on with unemployment, which I'll touch on in a second, and the economy. Just the scale of economic damage that's going on from this coronavirus shutdown. You look at the stock market and you're like, well, it doesn't look that bad. So if you look at that red line there, the S&P 500 is only down about 10% year to date. That's an index of large cap companies, so the Googles, Microsoft, Apples of the world. And then that green line, that IWM, is the Russell 2000 index. And that is an index of small cap companies. So, companies you've never really heard of before, but they're publicly traded. That's done worse. That's down a little bit more than 20% this year. But then you get the NASDAQ 100, which is an index of, there's a lot of different kinds of companies, but it's heavy in technology. So Microsoft, Apple, Google again. That index is actually up a couple percent year to date. Which, when you get right down to it, is kind of amazing when you look at the unemployment numbers, when you look at what economic growth is doing right now and all that. The idea that the stock market isn't down a lot more is puzzling a lot of people. But on the next slide, we'll kind of see what's going on, or what I think is going on. And it's really this: the stock market is always looking ahead. So whatever is happening today, it was already baked into the stock market before. So if we go back to March, when the stock market went down 30% in pretty short order, as it was coming to grips with COVID-related shutdowns, the economic data in March was still pretty good, but the stock market fell a lot. And that's because it was looking forward and saying these COVID-related shutdowns are going to cause big economic problems. So it kind of baked that in. But then in April, the stock market rebounded. And I think what's happening, or, I have a pretty good idea of what's happening here, is if you look at this chart here, it's a chart of earnings. So if you look at the blue lines all the way to the right, the third one in, you can see that earnings expectations for the S&P 500 index this year are going to be down. So right now, the estimate is that earnings are going to be down about 15%. It'll probably be more than that, just as consensus starts catching up to what reality looks like. But earnings are going to be down a lot this year. So I think a lot of investors have kind of written off 2020 already, and they're looking forward to 2021 and 2022. And if you look at expectations for those 2 years, basically investors are saying this COVID-related shutdown is going to be very short-lived. It's not going to last too long, and that things will go right back to where they were before. Now, whether that actually happens remains to be seen. And as I wrote in the blog this week, I think one of the biggest risks to the market right now is that earnings in 2021 in 2022 do not turn out to be as good as people are expecting. You know, here in Illinois, we've had our stay-at-home orders extended to the end of May, and a pretty lengthy 5-stage process to get back to normal. So I think the big risk for the market here, even though it has levitated and recovered a lot of its losses from March, the big risk right now is if the COVID-related recovery ends up being a lot slower than what people expect. So, but you know, for those of you that have kind of been looking at what's happening in real life with everything shut down and unemployment going up, and then you're looking at your 401k balance at the end of April being not that far from where it was at the beginning of the year, this is really the dynamic that's going on.
And Rob,
As it relates to economic data, I mean, today we're really starting to see the full scale of what's going on. So today we got the unemployment numbers for the month of April that was reported this morning, and people expected it to be really dire, and it really was. And so for the month of April, 20.5 million jobs were lost. And just to put that into context, the worst month of job losses during the Great Recession of 2008 and 2009, the worst single month was a job losses of 800,000. So when you put into context the fact that in 1 month, the U.S. economy lost 20.5 million jobs compared to what it did, you know, at the worst, which was a really bad recession 10 years ago. You know, that just really points to the scale of the suddenness and depth of the slowdown that we're going through. And you know, we know people have lost income either directly through layoffs, or they own a business and sales have gone down by half, or they're an independent contractor doing hospitality work, and their income has gone to zero. So, you know, the only solace is that fortunately the government moved pretty quick to add some unemployment benefits, so people are getting that. There's an extra $600 a week, but you know, but it's the scale of the slowdown here is really, really remarkable. And that's why, you know, frankly, when I look at the stock market going up, I mean, today it's up like 2% on a day that 20.5 million people were reported to have lost jobs. You know, I think it's best to keep in mind what's really going on, and that for the stock market, you know, the question really will be, for those 20 million people that lost jobs, how quickly will those come back? So that remains to be seen. And the other thing is the Atlanta Federal Reserve publishes and this goes back to a topic I wrote about in last week's blog, just economic growth estimates. So the Atlanta Federal Reserve publishes what they call a GDP now, gross domestic product now, and that's a measure of economic activity. And their update this morning for the second quarter of 2020 is for GDP to be down about 34%, which, you know, again, as I mentioned in my blog post last week, I mean, those are Great Depression-like numbers. You know, the hope, as I stressed last week in my blog, is that, you know, as things open up, as the shelter-in-place orders start to get lifted, as they are in certain parts of the country, that activity will snap back pretty quickly, probably not as quick what people and business owners hope, but any activity at this point would be good. So even though the numbers look really, really bad right now, the expectation is once these stay-at-home orders are lifted, that the economy will actually post a couple quarters of near record growth. So like 10 or 15% per quarter growth, which is remarkable, but only possible because we're going to be down so much in the second quarter of this year. So that's really where we're at right now. And, you know, we're just hoping that, you know, that the economic activity can bounce back. I didn't put a chart of this. I just thought of it right now, but I saw a chart yesterday of gasoline demand, and it bottomed about 2 weeks ago and is starting to trend up, which is probably a good early sign that activity is starting to come back. Again, the question will be the degree and quickness that it comes back, but there's at least some hopeful signs in that those gasoline demand numbers that rebound is starting to happen. So that's really the market update.
Yeah, no, that's really helpful to hear. So it almost sounds like, Rob, because
You're on mute.
let's see, can you guys all hear me okay? Okay. All right. So can you hear me okay, Rob?
Yeah, I got you. Yep.
Okay. So I want to kind of go back because you had touched on, these 3 weeks. So you write a weekly market update, and it's almost as if this happened so fast. And so that's why, I mean, you're talking about, the economy, and you wrote in this week's blog post, will company earnings recover in 2021? And you talked about how the market's always forward looking. And so when the market would pulled back, during the month of March, we had a big drop in the market, and it was thinking ahead. It was thinking, this is what's going to happen with companies, is they're not going to have the demand from consumers, things like that. And so obviously we had the natural pullback. Then fast forward, I mean, not even a month later, and the market is so much higher. And this is why, we hear from a lot of clients that say, I don't even want to look at my accounts, or just people in general. And we actually tell them, I think you'll be pleasantly surprised. Part just because diversification of how they were invested. But then the other is just that the market really has been volatile, but it has moved back up very quickly, actually. And so it's just interesting how, like you're saying, and you said in the blog post, how the market is forward looking, but it's almost like that happened so fast, even though we see that it's going to take probably a decent amount of time for the market to get back to where it was, or consumer activity. So that's, I think, the puzzling part, is how quickly the market came back in regards to how quickly the economic activity came back. And I think maybe that's where it's a little misplaced, because it doesn't seem like that's going to happen as quickly. Would you agree with that?
Yeah, and I think there's really two things going on. I mean, just, this is going to sound kind of old school, but I mean, we are in the internet age these days, and the market is definitely pricing in information a lot quicker than maybe what it would have in the past. So in the past, it would have been, looking at some incoming economic data. People are waiting for it, and they get it, and then they react to it. But now there's so much sort of anecdotal evidence that people can gather online through headlines and things like that, things are discounted very, very quickly. So, we just had the biggest and drop in the stock market in the shortest amount of time. We just had the sharpest rally in the shortest amount of time. So, that's one big challenge, I think, with investing these days, is market timing has always been really hard to do. I mean, nobody has been able to do that, even Warren Buffett. And it gets harder and harder as we go along, because the market moves around. So, I mean, you think about a month ago, and these unemployment numbers that were just starting to come out. I mean, I think any rational person would have looked at that and said, you know what, there is no way the stock market is going to go up. I mean, with all these numbers coming, it's going to look really bad. And yet here we are a month later, the stock market is 30% off the bottom, and we are getting these numbers. So,
Yeah.
It's really hard. So I think it's an information thing. And I think the other impact, which is something I'm going to start talking about in our weekly or in our monthly newsletters a little bit more, is just the impact of the Federal Reserve. Because, with every crisis over the last 25 years, there has been this kind of put option with the Federal Reserve, where the market goes down, investors are scared, and the Federal Reserve comes right in and they start cutting rates and saving the market, so to speak. And I think I think investors, this generation of investors, really has become so accustomed to just watch what the Fed is doing. If they're in there, if they're cutting rates, if they're supporting markets, don't fight the Fed is kind of what everybody likes to say. And, while there is truth to that, I mean, I think the fact that we've had, this recession and the past one being so severe and been so unnerving, I think, is actually a result of the Federal Reserve sort of, taking risk off the table. I mean, investors back in the day, if you made a bad investment, you lost all your money and that was it. And it's like, that's the way things are supposed to be in a capitalist society. But now it's like, people take risk because they think, even if I'm wrong, the Fed will come in and rescue me and I won't really lose any money. And unfortunately, I think the way the Federal Reserve has reacted the last, in the past crisis and this crisis, and I'm not saying they haven't done the right thing to kind of, save people as much as they can in this crisis. But I mean, the fact is, people are becoming accustomed to, if I make a bad investment decision, I'm not going to lose money because the Federal Reserve is going to come in. So I'm just going to take more risk because I know that they got my back. So that's something I'm going to write about a little bit more going forward, though.
Yeah, and that's where we want to see. So when the market's working as it should, companies doing what they should, protecting themselves for times like this, you want to see those healthy things happening. But even like as an investor, and even this week, Warren Buffett said, there's no place I see that I want to invest. And so it's interesting because people want to jump into things that have been beaten down. But even someone who's invested for many years is saying, you don't know what you don't know. Like, there's so many companies, you don't know how they have or haven't protected themselves. So it's so risky to say, let's get into those stocks when we don't know long-term what's going to happen. So it's really interesting, not from novice investors, but we're hearing those same things as these themes. But it's just so interesting how quickly the market moved, given how quickly or not quickly the economy might. So that's what's a little puzzling.
Yeah, and I mean, the other thing I would say, just with Warren Buffett, what he's really famous for is he keeps a lot of cash and he keeps a lot of dry powder. And 99% of the time, people look at his cash and they say, why aren't you doing something with that? But what he does and what his discipline has always been is to have enough dry powder on the side so that when we go through these extreme moments, which we go through, I mean, we go through crisis, we go through recessions on a fairly regular basis. And, the brilliance of his investment strategy is, I'm going to keep this dry powder knowing that 99% of the time I'm not going to need it. But in the moment that he has an opportunity to make some investments and everybody is selling and the market is going down, that's when he comes in and he makes investments. And they, not all the time, but most of the time turn out to be pretty good. And then he just holds on to them. And, I think there's a lesson in there, not only from investing, but also our own personal finances as well. Just the value of having dry powder, cash on the side, even if it's not earning a lot. You have that money there, not for the 99% of the time that life is going great, but you have it for that 1% of the time when we go through a recession, you have a job loss, medical issues, something like that. So, I think it's a really good reminder, looking at Warren Buffett, the way he kind of does things, how can we apply that in our own finances, not only for investing, but for everyday life as well.
Yeah, no, that's helpful. Thank you. So it's really helpful just to kind of walk us through in the last week and then what we're seeing as these themes emerge. And this really leads us well into the next area we wanted to touch on. And I know we'll be back to talk to you again, Rob, because we've gotten a question that is investment related. So we'll be back. But what we want to move forward now is now talking kind of about the fluidity of so much right now. So Steve's going to kind of talk us through this CARES Act, just as an example of one of the things that kind of explains how things are changing so constantly. So Steve, I'll let you take it away.
Yeah, so that would be a good description of this past tax season. Has been just constant change or fluidity, as you described it, Michelle. In recent past, we experienced the Tax Cut and Jobs Act, which reduced tax rates and widened brackets. For this one particularly, though, with the coronavirus, COVID-19, we noticed that Congress was trying to help out. So they started creating stimulus payments. They created PPP business loans and grants. And they've also just created ways to reduce or pause required minimum distributions or R&Ds from IRAs and 401ks. So all that to say is the law is constantly changing. We're seeing it change right in front of us, actually. With the PPP, Payroll Protection Program, those laws are changing in the sense where we'll see some of these articles here in front of us on the screen right now. What was written and intended in one way is now being actually being looked at as, will it be forgiven? Will it be taxable? Some of these laws are still being even debated. So the AICPA has actually come out and said that they're going to challenge whether or not you can deduct the expenses that you are using the funds for. So that's one. Another one here is right now, the filing deadline was changed from April 15th to July 15th. There's rumors or rumblings that the White House is considering even bumping that back to September 15th or maybe even December. So as we don't know a lot of this, we have to constantly be planning. Planning is ING, it's all the time. So as we know more, we act on it and we're prepared for how it will go either way.
Yeah, so let's take that specific example of the PPP funds, just so that people are aware and understand kind of this little nuance, because I think what's important here is that things are changing so quickly. So just to explain the details of this, so normally a business, an expense like payroll, they can deduct or they can take their total revenue, all the money they get for the products they sell, minus things like payroll, because that's not a profit, so that's an expense. So they aren't normally taxed on, you know, things that's normally profit. So if they take out things like payroll, those deductions, now the PPP said, we'll give you funds towards this, and then the IRS said, well, if you get funds towards those things you normally deduct, because that can be forgiven, they're saying now you can't deduct them. So it was kind of a back and forth. Wait, I thought I could get funds to help me cover those expenses, but then the IRS said, well, if you do that, now you can't deduct them.
That's exactly right. Yeah. So income less expenses gets you to net profit or loss. The IRS is challenging whether you can deduct using the expenses that you received from the funds from the grants, if you can use those as expenses to offset your income.
And that's where we put like these two screenshots of articles, because this literally happened, like the discussion of this was like within the span of a week. So earlier this week it came out, the IRS said, we're going to deny these deductions. And we were internally saying, wow, that's crazy, because this is meant to help business owners. And then now, as of yesterday, you know, the AICPA, an accounting organization, is saying we're supporting a bill that the Senate is putting together to actually make those deductible. So it's so interesting how in the span of a week. And I think this, though, highlights the importance of how we can't get wrapped up in everything that we're learning every day, because if you know the true intent of these things that are being put in place to help, so like Rob mentioned with the Fed, the intent is to help. But we do just need to, you know, it's going to be day by day. And if something seems a little off, give it a day or two, give it a week, because we aren't surprised when something new comes out to actually clarify something. So
yeah, I think what is really important to realize in all this is there's a lot of chatter. Nothing is set in stone yet. What we do know is we have 8 weeks to use funds. Clients have 8 weeks to use the funds that they were granted. Up to 7, all of it could be forgiven if used if they meet the requirements asked. So all those funds could be forgiven if used at least 75% for payroll, the other 25% for rent and utilities. So all of it may be forgiven. So what would be really important is for our small business clients and small business owners out there to keep a good track of everything that's spent. Starting with the date that you receive the funds, you have 8 weeks to use it. So keep on track, make sure that by the time that 8-week finish line hits, you have used the funds appropriately, you have it well documented. If that means adjusting a payroll period so that the funds are used within that time frame, that would be wise. We're helping our clients with that. That would be our recommendation to all those listening.
So that's just where it's kind of like, be sure that you're getting help as you hear these guidance, if you're choosing to use any of these programs, if they're important to keep your business, afloat during this time, all of those things. So yeah, thank you. And that's where we just really wanted to highlight, how fluid everything is and how quickly it's changing. So, all right. Thank you, Steve. That's helpful. All right, so next we're going to move to some questions that we have gotten from people over the past week. And actually, these have been some of our discussions internally with our team. So this was kind of fun to hear these. So I will let Rob, we're going to let you take this one, obviously. So this is an investment question. Why don't you go ahead and talk us through the answer to this? I've thought of investing in gold as a more stable investment in retirement. Is this a good idea?
Yes, so good question. And, I should probably say at the outset, I mean, when we do videos like this, we're not giving specific advice. So, everybody's situation is different. So everything I'm going to say about in answering this question is going to be general, just my general views. And, depending on your situation, you can kind of take it from there. So gold is actually pretty interesting. I mean, there's a lot of different views about it. Some people love it. People who love gold are called gold bugs in the investment community. It's like, you got to have gold. And then there's other people that think that gold bugs are idiots and, holding gold is old fashioned. You shouldn't do it. I'm more in the former camp. I'm not gold being the end all be all, but I do think there are a couple of qualities with it that make it attractive for some part of your investment portfolio, not all of it. The first thing I would say is, gold, what you have to know about gold, and you see it in this chart here in the bottom half of the chart, is gold goes through very, very long cycles. So if you go back to the early 70s, there was a run in gold, and then it kind of sat there for half a decade and then had another rally around 1980. I mean, if you're old enough, you remember the OPEC boycotts and gas prices and everything, and energy went up a lot. So there was a lot of inflation and gold followed it. And then after that, US policy kind of moved in a direction to bring inflation down, which they did. And if you look from really the early to mid 80s through all the way through 2000, gold really didn't do anything. It was around $400 an ounce for 20 years basically. And then we had another big run in the 2000s, culminating and top in around 2011, 2012. Kind of sat there for the last 8 years, and really over the last, call it 12 to 18 months, it started to pick up again. So the first thing you need to know about gold is it will go through very long cycles, and it will look like a bad investment for a long time, but when it does start working, it tends to move pretty quick, as you see. Now, we here at FDS, so for our clients, when we have investment portfolios, again, I'm just speaking generally, we do include some gold exposure in all of our client portfolios. And there's really, one big reason for that. Gold acts very differently than stocks. It acts very differently than bonds. And when you're creating a portfolio, what you really want to do is you want to find diversified assets that move around differently from each other. So as stocks go up, gold might not really do that well. Stocks, if they go through a really bad scenario, gold might tend to do well, or bonds tend to do well. And what they call that is correlation. And what we try to do here at FDS is we try to find different asset classes and different types of investments that have low correlation to each other, because we find that when you have an investment portfolio over the long term, it helps reduce the volatility of that portfolio over a many number of years, so 5, 10, 20 years. So that's why we include it in there, because when you look at the correlation of gold versus stocks, there's no correlation at all. So that basically means that how gold moves and how stocks move is really random. They don't influence each other. They don't move in the same direction generally. So we like gold because it's a good low correlation investment relative to stocks. Another reason why we have gold, which I think is, as I mentioned before, a little bit about the Federal Reserve. If you look at the policies really around the world the last 10 plus years, central banks have engaged in a lot of money printing. They've lowered rates down to zero. They are buying bonds from their own government, and this injects a lot of new cash into the system, and they're doing that because they're trying to spur economic growth. But what they're really doing is they're pumping a lot of new money into the system. And one of the old arguments against gold is if you buy gold, you have to store it. There's a cost to do that. It doesn't earn anything, so it's not like a bond that gives you quarterly interest. So a lot of people have always poo-pooed gold because, why would I buy gold when I can just buy a treasury bond from the U.S. government and earning interest, and I know I'm going to get paid back, things like that. Well, in the world that we're in right now, where interest rates are near zero, all of a sudden that math starts to change a little bit. And, the cost of owning gold really is not that high anymore, because if you don't own gold and you own something else like a U.S. Treasury bond, you're not earning a lot on it anyway. So it becomes, kind of in a classic sense where we're getting back to the gold's roots of being a store of value. And I think that's, that is one piece of the investment puzzle with gold that I think is starting to gain some traction, which you've seen in the last year. It's started to pick up a little bit. And just this idea that, the more money that's kind of pumped into the system, the value of the dollar gets eroded over time. And if you don't want to see the value of your dollars eroded, you own something like gold because it tends to hold its value a lot more. So, that's a very long-winded answer. You can see I am a bit of a gold bug. I love to talk about it and all that. But, the short answer is it, a good thing in retirement. I mean, I think it could be, small percentage. I mean, nothing too big. Think of it as a hedge against inflation potentially down the road. Think of it as a diversifier for your overall portfolio. But also be cognizant that it might do nothing for 20 years. So that would be how I would answer that.
Yeah, and I think it's key, they said, should I invest in it in retirement? So, I mean, in retirement, you want to make sure your funds are available, but you also need to make sure that they're keeping up with or able to grow as to what you need for the rest of your life. So that's where this is a great question, because like Rob mentioned, we have an allocation to various asset classes, gold being one of them. And this is where we do have a part in it for our clients, but these are the conversations that we're having is, what stage of life are you in? What do your funds need to be able to do? And now how do we invest them now with that in mind? So that's really helpful. Great. So I hope that's a helpful answer.
And probably just last thing, and I mean, this is very short term, but just a little proof in the pudding. I mean, the stock market's down 10+% this year. Gold is up about 13. So, it has done its job of being a diversifier for client portfolios.
Great. Thank you, Rob. All right. So that was a great question, because we've talked about that internally. So now we're going to go to question number 2. What should we do with the stimulus funds we received? So this has to do with the money that people got, the economic recovery rebate checks that people received or deposits into their account. So we are going to let Trevor take this question for us.
Sounds great. Thank you. Thank you, Michelle. So I just want to talk real kind of briefly about what these stimulus checks are. They are a provision for monetary tax. If you file a return and have a direct deposit, chances are you've already got your payment contributed all the way. So that's always good. The next thing is, if you don't have your payment just yet, it turns out that you may actually be getting a check here in the next couple of weeks. So the good news is there's a tool provided from the IRS's website You can actually go onto that tool. If you search irs.gov/coronavirus, there's a Get My Payment tool. And you can enter some of your information and determine, okay, where is actually your payment if you haven't received it yet. You can also verify that, hey, it was direct deposit or whatnot. So just to make sure that that's clear in case you haven't gotten it yet. But let's assume that you have. You're following the question, what should you do with these funds? And like every good planning answer, I think the best answer is that it depends. From a advice perspective, we're big proponents. We want to make sure that you have your emergency fund established and fully funded. We're in a very big environment right now where things are uncertain. We don't know what tomorrow's going to hold. We don't know what next week, next month, next 3 months, next quarter are going to hold. So it's really important right now to make sure that your emergency fund is fully beefed up. That if you don't have your 3 to 6 months of living expenses built in there now, where you fall on that spectrum depends on a lot of factors. So please let us kind of talk through what the right number is for you. But we want to make sure that first and foremost your emergency fund is built up. Once that's gone, the next thing that we can look at doing is are we maximizing any available employer benefits that we have? So the employer benefits that we're talking about here are our 401k. As we look at a 401k, a lot of times our employer gives us money when we need it. So we want to make sure that we're making use of those funds when we can. So that's a great next step. If we have our emergency fund fully established and we want to say, okay, I have more funds than I need on the side here from a cash perspective, how can I start putting this money to work? So your 401k is a great next step. Beyond that, you can start looking at your individually owned IRAs, your Roth IRAs, any investment accounts that you have separately and personally, whether it's an account we manage for you at Charles Schwab, any other side accounts that you may have. So those are some of the good things to kind of be looking out for. I would say it may not be a good idea to selectively pick and choose an individual stock here or an individual stock there. It really falls back to what's your overall investment perspective and allocation looking like it wants to be, and make sure you follow those lines.
Yeah, no, that's really helpful. And it's interesting because someone asking this question might be someone who hasn't had their income affected. So they're still able to work from home. Nothing's really changed financially for them. So they may be saying, this is actually extra money that we've gotten. Now, what can we do with it? Because they fell within those parameters. So it was just money that they received. And it's always interesting as financial advisors, the last thing we ever want to do to help people work with an advisor is to scare you or to use a time like this to say, see, this is why an emergency fund is needed. We never, ever want people to feel like that. Rather, we want to encourage you to have these things in place, because then you see in times like this how you can move through them. You can, work through them to give yourself time until we move through it and we get to the end of this, or you have a new job or things like this. So that's why it's such a great point that there is a process, and it's almost like you earn the right to invest once you're set up and you're ready to actually invest in that, rather than skipping any of these steps. So then, you don't have things in place and you have to make other decisions. So thank you for explaining that, Trevor. All right, so then our next question. So a third question that we've gotten, and Trevor is going to take this one again, is should we consider refinancing our mortgage now?
What a timely question. With rates as low as they are, it's a really appealing scenario. If you have a mortgage and your interest rate is above 4, there's a good chance that it could be worthwhile for you to look at refinancing. Now, lots of variables that go into this. One is what's your current interest rate that you're paying on your mortgage. So that's step number one, making sure we have a clear idea of what that is. Secondly is what does your credit look like? In order to refinance at some of the rates, you're going to need some really great credit. Thankfully, most of the folks that we talk to have phenomenal credits to see. And then beyond that, we can start looking what are some of the rate offerings that different banks or mortgage brokers might be offering. So we can take those variables in and say, okay, what's our interest rate spread that we might start looking at? But another factor that also comes into play when we're looking to refinance is how much are the refinance costs going to be? You know, in other words, if I'm going to take a 4% interest rate mortgage to a 3.5% mortgage, there are costs, administration costs and title costs associated with moving from 4% to 3.5%. So we want to be mindful of what those costs are, how large they are, because the larger that those costs are, more often than not, it can eat into any potential savings that you may have. And we have a lot of tools here that we can start analyzing and break even review. You know, we assume closing costs, you know, we'll call it $2,500 to $4,000. A variety of different scenarios and trying to figure out what's going to be. It's interesting to see that sometimes a not so obvious answer might be the best one for you and your family, but we can always you know, hunker down and figure out what's actually going to make the most sense for you.
Thank you, Trevor. That's really helpful. And I think too, it's interesting because again, this really goes back to where are you at? You know, some people might only have a handful of years left in their mortgage, so it might not make sense. Can you manually pay it down faster rather than actually refinancing? So many of these questions, when we say it depends, it really does. So as frustrating as that might sound that we don't give a concrete answer, everybody's in such a different place. So of course, you know, to save money and to shorten a length of a mortgage and to get a lower payment, all of that would be wonderful. And yes, you want to do that. But if it puts you in a place where you can't put food on your table and you can't do the daily things that you need to, then that's going to be a very different answer. And so that's why we always, you know, that's why we always get to know the situation of our client so that we can really give you the advice that's best for you. So these are wonderful questions that people have submitted. So just like this, if you have questions, please let us know. Please put those in the contact section, comment section. Or also you can email them to us. As we're hearing questions, we're just posting, you know, putting those in here as well. But these were great. So hopefully these are helpful for you. Just to kind of touch on a couple things, resources we want to be sure that you know are available. We know that as things are changing and everyone's at home, sometimes you're at home and you don't know what's changing outside of your four walls. And so that's why we've been recording these videos while we're socially distanced, but getting updates, so a legal update because the courts are closed. So that affects things like estate planning, even getting a notary, things like this. And so we wanted to be sure that you have up-to-date information of ways you can still get these things done, or that if something happens, you are prepared and you know, okay, now I know, you know, how that's functioning. So, so that'll help you if that happens. Insurance, we did an insurance update with Ryan Delp at Bradish, and then the legal update with Heather Walser at Lavelle. So those are really helpful resources. We'll just keep reposting in shorter snippets in case you want to watch shorter videos. We have one coming up this Thursday where we are actually going to get more in depth on the refinancing and what's actually happening in the refinancing market. So we're going to hear from a mortgage loan officer, so we actually know what's happening there, and you can hear some of the things, because like this environment where now rates are low, obviously there's a huge increase of demand for that, but there are some other things that have changed to kind of help, you know, to make sure that banks are having, they have good risks, and so they're letting investors or borrowers who are a good risk and can repay those. So I just want to be sure that we're explaining those things to you. And then other resources that we have, we mentioned our market update, and we send those weekly. So that's a weekly email. If you want to go to our website, that you can subscribe to receive those. We have a written blog every week for the market, and then a video blog on various financial planning topics. Our CARES Act resources. So this was written right after that the CARES Act came out, explaining each of these pieces. So there's a page on each of the sections that might be applicable to you. Again, you can go to our website, and I'm going to put all of these here in the description of the video, so you can click on these links, but please go read those. We've got some things to watch out for if you're going to use any of these things as well. And then just the live video updates we mentioned, and then also we have a monthly written that we mail out, so we can be a little more in depth. So in this monthly newsletter, Rob gets a chance to actually write multiple pages about his market update. He can write whatever he wants, and it's just a little more in depth rather than our quick every week update. So if you would like to get that, please just email us, team@financialdesignstudio.com, and we'll make sure you get on the list. But any of these resources are really created to help you. So if there's anything that we can help you with right now, please reach out and let us know through any of those ways, because we're happy to do that. We want to be sure we're providing things that are actually informative and helpful. But yeah, this actually wraps up today. So thank you so much for bearing with us, being patient when technology might not have been on our side. But please let us know what questions you have, and we'll talk to you again next week. And thank you, Rob, Steve, and Trevor, for talking us through all of these answers.
See you next week.
All right, bye.
I guess.